The general features of financial statements under IAS 1 Presentation of Financial Statements. Introduction. Financial statements are crucial documents that provide essential information about a company's financial health and performance. Under the International Financial Reporting Standards, IFRS, specifically IAS 1, or call it International Accounting Standard 1, which is entitled Presentation of Financial Statements, there are several general features that ensure consistency and transparency in financial reporting. In this session, we discuss these features and their significance for financial statement users. The first feature is fair presentation and compliance with the International Financial Reporting Standards. The foundation of any financial statement is the requirement for fair presentation and compliance with the International Financial Reporting Standards. This means that financial statements should provide a true and fair view of the company's financial position, performance, and cash flows. It also necessitates strict adherence to the International Financial Reporting Standards guidelines to ensure consistency and comparability across different entities. Going concern. The going concern assumption is a fundamental feature of financial statements. It means that financial statements are prepared with the assumption that the entity will continue its operations for the next foreseeable future. This assumption is vital because it affects the valuation of assets and liabilities and impacts the classification of items as current or non-current. The accrual basis of accounting. The accrual accounting is another essential feature of IAS 1. Under this basis, transactions are recorded when they occur, not just when the cash exchanges hands. This ensures that financial statements accurately represent the economic substance of transactions. For example, revenue is recognized when it's earned, even if the payment is received later. Materiality and aggregation. Materiality is a key concept in financial reporting. It suggests that financial statements should not include trivial details but focus on significant items that could influence the decisions of users. Aggregation is used to combine similar items in the financial statements to make them more understandable without losing important information. Offsetting. Offsetting refers to the practice of reporting an asset and a liability or income and expenses as a single net figure. In general, IAS 1, or call it the International Accounting Standard 1, discourages offsetting as it hinders users from evaluating the total value of each element in the financial statements. It may be allowed in certain specific cases, but overall, transparency is favored. Frequency of reporting. IAS 1, call it the International Accounting Standard 1, prescribes that companies should present at least one balance sheet and one income statement per year. However, companies often provide more frequent reports, such as quarterly reports, to keep stakeholders informed. Comparative information. Comparative information is crucial for understanding a company's financial performance over time. Companies are required to present comparative financial statements from the previous period. This enables users to assess trends, changes, and the company's overall direction. Consistency of presentation. Consistency in financial statement presentation is vital to ensure that users can easily compare financial information over different periods. The framework defines the consistency concept as requiring businesses to use the same accounting policies from one period to another, unless there is a valid reason for change. In conclusion, IAS 1, or call it International Accounting Standards 1, which is entitled Presentation of Financial Statements, plays a pivotal role in ensuring that financial statements are clear, transparent, and provide useful information to users. The features discussed in this session emphasize the importance of accuracy, transparency, and consistency in financial reporting, which is essential for stakeholders, including investors, creditors, and the general public, to make informed decisions. Adhering to these general features enhances the credibility and reliability of financial statements and strengthens trust in the financial markets. My name is Arnold Kisembo Rwangakuramya. Thank you for watching.